Good day, everyone. This is a quick update on the CPS portfolio ranges in terms of the performances and a quick update in terms of portfolio positioning. Performances during the period were largely driven by the global assets, while local assets experienced a challenging quarter. Global equities, as measured by the MSCI All Country Index, gained just over 6% in dollar terms, with the US and Japanese markets contributing most to these returns. The US market in particular has been a strong source of returns since the latter part of 2022, with large tech companies driving these returns. For the 6 months, the S&P 500 gained 15%, while the Nasdaq has surged by 30%, this being its best first half since 1983. Global bonds, in contrast, recorded a negative 1.8% return as developed bond yields rose further on the back of continued rate hikes by most world central banks. Rand weakness of about 6% further supported global asset class returns for the quarter, as well as the 12 months ending June 2023. As we said in the intro, local asset classes endured a difficult quarter as sentiment turned sharply negative on a few factors, which included 1. Intense load shedding and concerns of a possible grid collapse, geopolitical tensions between SA and the US, and 3. Further interest rate hikes, which caught many by surprise. If we look at equity, our equity market gained over 1% during the quarter, with the rain hedge industrials and banking stocks being the outperformers, while resources in contrast endured another difficult quarter, with the RESI 10 index declining by 6.5% as concerns around global growth resulted in lower commodity prices. With regards to bonds, despite the recovery in bond yields in June, the ALBI recorded a negative 1.5% return for the quarter. Some of the more important portfolio movements during the quarter were: 1. We increased global bond and global cash exposure as rates increased and made these asset classes more attractive. Number 2, within local fixed income, we increased the local cash exposure given where current cash rates are, and this was funded both by trimming both local and the global equity after the strong recovery from the fourth quarter of 2022. Just looking ahead, some of the concerns we have: 1 is the impact of sustained higher interest rates on economies as well as asset class prices, and number 2, the very narrow and concentrated returns of the US equity market. And within the South African context, without stating, at the risk of stating the obvious, the continued negative sentiment towards South Africa. So what have we done to mitigate against this? 1, we continue to have a well-diversified portfolio, and we continue to manage the portfolios actively. We have also completed the transitioning of our portfolios to our new long-term strategic asset allocation, with the benchmarks to be changed effective 1 July 2023. Thank you.